Good morning, ladies and gentlemen. Thank you for joining us for our oil market report update. The OMR just went out, as you all know, and we are holding this media webinar. With us this morning are Dr. Fatih Birol, our Executive Director, and Neil Atkinson, the editor of the Oil Market Report. Just to give you a sense of this morning, we'll go for about 30 minutes. Fatih and Neil will make a short presentation, and we will have time for a few questions. So please type your questions in the Q&A box. And before we start, let me just give you two short calendar items from the IEA. On the 20th of May, we are releasing our renewables market update for the renewables market. That's the 20th of May. And on the 27th of May, our investment report, global investment figures, will be released. So without further ado, I'm going to turn it to Dr. Birol. Fatih, for your introduction, please. Thank you.
Thank you very much, Jet. Good morning and good evening to some of you, dear colleagues. We have our scheduled May oil market report after our meeting in April. In such a context, we are now back with our new report. So I am going to give you some of the highlights I thought are key, share them with you, and my colleague, Mr. Atkinson, will give you further details. First of all, our overall message, when I look at all the numbers we have on the demand, supply, country by country, I can say that globally, we see early signs of a gradual rebalancing of oil markets. Just to repeat, we see early signs of a gradual rebalancing of oil markets. It is still gradual and it is still fragile. We see several uncertainties ranging from the developments related to coronavirus in different countries and globally, the global economic recovery efforts, and also the policies in some key producing countries. Some of you would remember we said when we had our last oil market report that the 2020 may well be a worse year of oil industry, and April, I call it the Black April, may well go the black month in the history of the oil industry. And our numbers we are going to share you today do confirm that we are on track. 2020 will be the worst year, and April being a black month. Now, I want to share with you three important dimensions. One on the demand, second on the OPEC plus production profiles, and third, maybe most importantly, developments in the producing countries outside of OPEC plus. And these are fully in line with what the IEA said during the extraordinary G20 meeting as a prescription, 3-point prescription to see a rebalancing of the oil markets, and the developments have confirmed our expectations. On the demand side, we are expecting that the demand slightly better or less worse, I should say, compared to last oil market report in April. Our expectation throughout the year is now 8.6 million barrels per day of a decline compared to 9.3 last oil market report. This is mainly as a result of the more and more people are going out of the confinement, and our numbers show that this easing of the confinement and new data, especially on the mobility, road transportation, gave us the impetus to revise our numbers, and it is now 8.6 million barrels per day we expect compared to 9.3. In the context of demand, one issue I have raised with you and also in the G20, which is, I think, important, is the increase in the strategic stocks. We have highlighted this as an important item, both for energy security, oil security, and also helping the global oil market stabilization. And our numbers show that in the last 45 days, we have seen an increase of 60 million barrels increase in the strategic stocks, mainly coming from US, China, and India. This is equivalent to 1.2 million barrels per day. So this on the demand side, driven by the lifeline given to road transport, especially cars, petchem still remaining resilient. We got rather, compared to last oil market report, a more positive picture here. The second important issue here, in my view, is the what is happening with the OPEC plus countries. In the meantime, we have seen that the OPEC plus agreement was effective on 1st of May. And in addition to that, Saudi Arabia, UAE, and Kuwait made additional voluntary cuts, at least announced them, in addition to their commitments. I do welcome these efforts coming from the OPEC plus countries, and especially the additional ones coming from Saudi Arabia, Emirates, and Kuwait. So we hope to see that those commitments are fulfilled, and we will be following the compliance carefully in the next weeks and months to come. The third part after demand, including the SPR and the OPEC plus, the third important item, which is perhaps the main driver of us seeing an early signs of a gradual rebalancing of the global oil markets, is developments on the non-OPEC countries, non-OPEC producing countries. We see a strong demonstration of the power of market forces as the higher cost producers, such as US, Canada, react to lower prices as well as logistical bottlenecks. Our current numbers show that by end 2020, by end of this year, it is the United States that is the biggest contributor to global supply reductions. Our expectation is US production could be 2.8 million barrels per day lower than end of 2019 at the end of this year. So throughout 2020, US production could go down 2.8 million barrels per day, and it is the single largest in 2020 contributor to the global supply reductions. We see similar reductions, expectations from Canada, and as well as efforts coming from other countries such as Brazil and Norway. So overall, the developments in the non-OPEC producing countries, we believe, is a major contribution to market stability. I stop here and by repeating our message that we hope to see Black April behind us, and we are expecting a gradual rebalancing of oil markets, and of course there are huge uncertainties remain. So with this, Jet, it is back to you.
Many thanks, Dr. Birol. Now I'm going to turn the floor over to Neil for his presentation. Thank you.
Thank you very much, Jad, and thank you to Dr. Birol for that introduction. You will have seen the full copy of the May oil market report, which was released early this morning under embargo. What I'm going to do in the next just a few minutes is show 3 main slides summarizing the key messages on demand and supply, and then the market balance to give you an idea where we think the market's going in the next few months. And the first chart, which I'm just flicking on now, summarizes our outlook for demand. We've headlined this chart, Global Oil Demand, the worst might be behind us. We're perhaps a little bit more confident than might, but obviously the uncertainties around the coronavirus pandemic are still very large. But as you can see from this chart, which shows the year-on-year change for global demand, we've broken it out by product in this particular chart. April, as Dr. Birol says, was most definitely Black April. We have made the data for April and May and June slightly less bad than we published a month ago. In fact, for the second quarter of 2020, we've actually increased our demand outlook versus the last report by just over 3 million barrels a day, which in normal circumstances would of course be absolutely unknown and quite incredible. But as the chart shows, as we move into the second half of the year, as Dr. Birol anticipated, we start to see rebalancing in the market. In a few moments, I'll show you what that means for the market balance. But certainly, as we progress through the second half of the year, because of the easing of the lockdown measures that all of us have been living under, we should start to see demand improve. Obviously, one of the standout areas that is going to be hit for harder and for longer is the aviation industry. And in the combined jet kero slice you can see on this chart, where we see jet still remaining very, very weak as we get towards the end of this year. But we must emphasize in the final sentence of our points at the bottom here that the resurgence of COVID-19, which we all hope doesn't happen, is an enormous risk factor to this outlook. But we've improved the outlook, minus 9.3 last month, minus 8.6 this month, so we're heading in the right direction. Just one slide on supply, just to summarize some of the points that Dr. Birol made a moment ago. We're into May, the OPEC Plus agreement has just come into force. It's obviously very early days yet to get any idea as to what compliance actually is. We'll know in perhaps another week or so, some early data. And in the next edition of the market report in mid-June, we'll obviously be reporting on the first month of compliance. But when you take together the expected declines anticipated by the OPEC Plus agreement, plus the non-OPEC production cuts that we're already seeing, led by the United States and Canada, we anticipate that in the current month of May, we could see global production falling by about 12 million barrels a day, which unsurprisingly is, for you, I'm sure to hear, is a record. This is an incredible reduction in 1 month. But we've already seen, of course, production in the United States and Canada and elsewhere falling already this year. And we think that US production, Canadian production, and the other non-OPEC countries, that could be down by about 4 million barrels a day in June compared to the beginning of the year. As Dr. Birol said, and there is a slide in the report which explains this in more detail, at the end of this year, we will certainly be in a position where the United States at the end of this year will have contributed the largest production cut, even more than Saudi Arabia, because you must bear in mind that at the end of 2019 and certainly in the early part of 2020, production from Saudi Arabia was very, very high, obviously coming down sharply since then. So that's an interesting point that's emerged from our research this month. The final slide I'm going to show you today summarizes what we think the overall market balance looks like. Now, this slide is the implied stock change, that is the difference between demand and supply. It isn't, of course, what the final stock changes will be, because stocks data is a lagging indicator and it'll take time for the final numbers to work their way through. But the implied stock changes, they're actually quite significantly lower than we forecast last month, because, as I said, we've upgraded our second quarter 2020 demand number, and the production from the non-OPEC countries in particular, as Dr. Birol said, has come down a little quicker than we thought. So the implied stock builds have come down, but they're still pretty enormous. We're looking at, in the first quarter there, around about 6.5 million barrels a day, something like that. And in the second quarter, the implied stock change is still well above 12 million barrels a day. However, and this is a key message which Dr. Birol alluded to at the very beginning of his remarks, as we move into the second half of 2020, on the assumption of no resurgence in the COVID-19 epidemic, on the assumption that the economies do start to pick up, and on the assumption that there is still production discipline amongst the OPEC plus countries, and that the levels of production in some non-OPEC countries remains relatively low. On that basis, we do start to see destocking in the second half of the year. And as the bullet points at the bottom suggest, we think stocks, having built by nearly 10 million barrels a day in the first half, could start to draw by 5.5 million barrels a day in the second half of the year. So I'll leave it at that point to allow time for your questions, and thank you for your attention.
Thank you very much, Neil, and thank you for your presentation. So we have a number of questions that have come in. We're going to take them by threes just to, in the interest of time, make sure we can handle as many as possible. First, three questions, which I will direct to Dr. Birol first. The first one from Grant Smith. Dr. Birol was calling on OPEC Plus to do more, as the cuts announced in April didn't seem sufficient. After this week's announcement of deeper cuts from Saudi Arabia and others, do you now feel they're doing enough? Question number one. Question number two from David Hodari. Are there any producers struggling to cut production due to economic engineering or geological factors? Are producers struggling to cut production? And then the third one, one on petchems, from Jonathan Lopez, who wanted to ask about petchems. What do you expect for that industry now the sector is depressed due to demand, to end demand being absent? What about the coming quarters? So,
Okay.
Fatih, floor is yours.
I can start. Maybe Mr. Atkinson can also say a few things. The first question is yes, we have towards the end of April, we made a call, and I said it would be very helpful if the key OPEC plus countries would consider deeper cuts. And at that time I said, and I hoped that the OPEC plus agreement would come in effect, not 1st of May, but before 1st of May. In any case, I am happy to see that the Saudi Arabia, Emirates, and Kuwait, on top of their existing commitments, are now going to make further cuts. I do welcome them. Whether or not this is enough, I do not think so. But we also see that as I mentioned, production cuts coming from US, Canada, other countries, and demand is giving signs of early signs of recovery. So we will see how much cut may be needed in the future, but we said we have the early signs of a start of a recovery process in the markets. It is far too early to say that we are soon going to reach a rebalancing of the markets. We are just in the beginning of that very process. The second question, yes, some countries have more difficulties compared to others, given their economic situation, political situation, and others. Now, I would like to especially single out here Iraq, a country which has a lot of difficulty, and hope that Iraq, under the leadership of a new prime minister, will be able to address oil as well as the electricity market issues, and we will be working very closely with Iraq to support them, especially designing of electricity markets. Now, in terms of the petrochemical, so I wouldn't think that the petrochemical is so badly affected as the other sectors of the oil consuming sectors. There are two types of effects for petchem. One is that we see a push for demand as a result of the increasing need for protective equipment, medical equipment, disinfection products, packaging for in many cases. But we also, of course, saw downward pressure on the for the petchem input for the automobiles and the construction sector. Most of the pipelines are plastic. So at the end of the day, petchem was definitely not the one of the sectors which is badly hit. In fact, I would say the opposite. It was perhaps the most resilient sector within the oil consumption side. Thank you.
Thank you very much, Fatih. We're going to take another minute to see other questions as they come in. Please use your Q&A function in the Zoom application. Okay, we're going to take two more questions. I'm seeing the time is running out, so will take a couple of more questions. One from Rafiq Latta. I'll direct this one to Neil. Neil, could you tell us your where do you see Brent this year and next into 2022, and how does that differ from our pre-coronavirus projection? And then another question, perhaps also to you, Neil, that in last month's report, this one from Grant, IEA warned that global oil storage was said to be exhausted by the middle of the year. This month, the report does not feature this warning. So do you still expect that to be happening? And then once you're done, we'll turn it back to Fatih for some concluding remarks. Neil, please. Neil, I probably need to turn your mic on. Neil?
Okay, can you hear me now?
Yes, I can. Okay,
thank you. Sorry, you had to do it. Okay, as far as Brent is concerned, as you know, we don't publish short-term oil price forecasts. Ordinarily in our research, we use the forward curve for the short-term work. Longer term out to 2025, we published a report earlier this year, and at that point we were using essentially a forward curve out for 5 years at around $60 a barrel for Brent. Obviously, the turbulence in the market and the huge uncertainties make forecasting, let alone in 2021, it's difficult enough this year. So we don't have an official published outlook for Brent as such. In the next report, published in mid-June, we will be extending our forecast period out through 2021. And when we make that forecast, we'll obviously be looking at the forward curve at that point as a guide. It's not always followed religiously, but as a guide. And we'll come up with our supply-demand numbers at that point. Suffice to say that if our balance projection, which we showed a moment ago, the implied stock change does turn out to be accurate, there is production discipline, no resurgence of COVID, and stocks do start to fall sharply in the second half of 2020, intuitively you would expect prices to be firmer and possibly to increase. But there are so many uncertainties, it's not a forecast I would necessarily take to the bank. Secondly, on storage, we did actually refer in the report to the fact that because production is coming down faster than we indicated in the last edition of the report, and therefore the implied stock builds are lower than we published last time, it is less likely that the phrase filling capacity will actually happen. Obviously, there are some localized situations. The United States is very well known. Indian stocks are thought to be very, very full. But globally, as we do show in the report, it's expected that the trend of stocks filling will start to turn around as we move into deficits in the second half of the year. So we're not saying that the problem is over, but we think the problem is less pressing than we first thought a month ago.
Thank you very much, Neil, for this. Before we conclude, I'm going to turn the microphone back to Fatih. There is one question, though, that did come in, which perhaps, Fatih, you could answer, which is concerning G20. What would G20 producers do as you were involved in this process? What insights can you provide on this? And also, I note that there are a number of questions that we will be able to answer in our renewable market report and our investment report about the overall impact of the crisis on the energy mix. So I would ask you to please return on the 20th of May for our renewables market update, or our investment report on the 27th of May. Also to note, if you still have questions on this month's report, please email us at press@iea.org. We can get back to you quickly. Fatih, please, for your remarks.
Thank you very much. Before going to G20 question, just put following what Mr. Atkinson just said. One issue escapes the eye of the observer in general when we look at the debate and the oil markets. This is the very strong increase in the floating oil around the world. Now, our numbers, our analysis show that in April, in the Black April, there was a huge spike for oil on the sea. The additional volume of oil in the ships has increased by 158 million barrels, or over 5 million barrels per day. To put it in a context, it is like that for 1 month, the total production of Nigeria plus United Arab Emirates combined has been put entirely on the sea. There was a huge growth, and we see that a similar trend is also following this month. Now, coming back to the G20 producers, I think G20 meeting, as I mentioned, my expectation from the G20 was threefold, and they are all going, at least for now, in the right direction. One, the OPEC plus countries agreement now in effect, and plus 3 other producers said they will make additional cuts, and we will see how the discipline is, as Mr. Atkinson said, and whether or not there will be need for further cuts in the future. The second, I would definitely suggest you to look at our numbers carefully. There is a huge decline coming from the other G20 countries, such as US, such as Canada, and others. There is no need for a formal announcement. It is happening, and we are telling you, we are announcing you, only United States, we expect around 2.8 million barrels per day decline. And let me reiterate, this is the largest decline of all the countries in the year 2020, as such, helping the stability of the oil markets. And the third one is the increasing oil in the strategic stocks. As I said, in the last 45 days only, we have seen an increase of 60 million barrels, mainly coming from US, China, and India. And therefore, all these 3 points of prescription of the IEA have suggested is basically on track. Early days, still fragile, still lots of uncertainties, but once again, we are able to tell you that we see early signs of a gradual rebalancing of global oil markets. Thank you.
Thank you very much, Dr. Birol. And this concludes our webinar presentation for the Oil Market Report for May. If you have more questions, please email us at press@iea.org. We'll get back to you. Thank you for your attendance, and we will see you around very soon. Thank you.